The backbone of the artificial intelligence boom looks exactly like this. Millions of processors running red-hot in warehouse-sized data centers, processing the math required to train modern language models. And this is a retail display of eco-friendly sneakers made out of merino wool. These two things have zero overlapping DNA, but Wall Street just decided to reward a failing shoe brand for suddenly declaring itself an artificial intelligence firm. If you want to understand how the market really operates right now, hit the subscribe button because we need to unpack the mechanics of this pivot. Before April 15th, Allbirds was actively bleeding cash. Between 2022 and 2025, their sales dropped by nearly 50%, falling to $152 million. They closed all their full-line U.S. retail stores, and internal reports openly discussed the possibility of total liquidation. Then came the press release. The company announced it was abandoning its apparel roots entirely. They sold their shoe brand intellectual property and rebranded themselves as NewBird AI, stating an intent to buy high-performance GPUs and lease them out to corporate clients. This chart shows the immediate reaction on Wall Street. Within hours of the announcement, the Bird stock price spiked vertically by over 700%, hitting its highest level since last July. An apparel manufacturer with no computing infrastructure, no chips, and a history of heavy retail losses promised to enter the most capital-intensive technology sector on the planet, and the financial market threw money at them. To see how a retail operation turns into a tech shell overnight, we have to look past the press releases and into the corporate restructuring. First, the company executed a definitive agreement to sell the entire Allbirds brand and footwear assets to the American Exchange Group for $39 million. This pie chart illustrates their $50 million convertible financing. An investor gives cash now for debt converting to stock later. When that debt converts, total shares expand, forcing existing retail ownership slices to shrink dramatically, introducing extreme dilution risk. Armed with that cash, NewBird AI claims it will acquire low-latency computing hardware and lease it to customers under a GPU-as-a-service model. Strip away the tech buzzwords, and the mechanics become clear. Selling off core assets and taking on convertible debt is a desperate financial survival tactic for a dying company. Building large-scale AI infrastructure requires specialized cooling, massive energy grids, and deep expertise in silicon architecture. The executive team at Allbirds has a background in renewable resources and designing footwear. They have exactly zero institutional knowledge of high-performance computing. They are attempting to compete in a market dominated by hyperscalers and hardware giants who have spent decades perfecting chip design and data center logistics. Retail communities on Reddit saw the absurdity instantly. Users filled message boards joking about shoe-free data centers and AI-powered shoelaces. Yet, while the internet logically dismissed the pivot, institutional trading algorithms and speculative investors went on a massive buying frenzy. When a company's market capitalization completely detaches from its literal ability to execute a business plan, the market is no longer pricing in future value. It is pricing in hype. We have seen this exact behavioral pattern before. Financial history has a reliable rhythm during periods of intense market mania. In 1999, failing steel mills and retail outlets attached a .com suffix to their corporate names, watching their stock valuations multiply overnight without writing a single line of code. In 2017, a struggling beverage distributor called Long Island Iced Tea rebranded itself to Long Blockchain Corporation. They promised to explore digital ledgers, and their stocks hiked 380%